REITs have historically offered above-average returns. Still, they are more volatile than stocks because of their exposure to market cycles. There's a complicated relationship between investors and real estate, and this expert breaks down how investing in real estate can diversify your portfolio. Whether you are a long-term investor or a real estate flipper looking to buy and sell homes each year, many different strategies exist. Here's why you should consider investing in real estate. Welcome back to the Ring of Knowledge, your trusted source of practical financial knowledge. Today's video will discuss the beginner's guide for real estate investors. So let's get started. Real estate is one of the 5 fundamental asset classes that every investor should consider in their portfolios. It provides one-of-a-kind advantages regarding cash flow, liquidity, profitability, tax benefits, and diversification. Investing in real estate is a broad category that includes operational, financial, and investment operations centered on profiting monetarily from property or cash flows related to a tangible asset. What is the real estate investing process? The acquisition of property to rent or sell is known as real estate investing. Real estate consists of a parcel of land and any buildings or other structures attached to it. The term real estate refers to the land itself and anything on the property, whether it was produced by humans or by nature, such as buildings, trees, or fences. You may encounter situations in which people use the terms land, real estate, and real property interchangeably. Nevertheless, these terms can be distinguished from the others in a few key ways. The land includes all natural surfaces, the airspace above them, and anything else that may be attributed to being a component of Mother Earth. The property itself, as well as any permanent manufactured modifications, such as a house, is considered to be part of the real estate package. Real property refers to the incentives and advantages of being a property owner. Buying a plot of land and any structures or improvements built on it constitutes an investment in real estate because it includes all these components. Real estate investment may be broken down into a few distinct categories, the most common of which are residential, commercial, and industrial. How do you make money when investing in real estate? Real estate investing is a tried and true means of producing money, and there are many different methods in which you might profit from this endeavor. Value appreciation and revenue from rental properties are the 2 primary strategies. There is a consistent trend throughout history of property values going up with time. This phenomenon is referred to as value appreciation. Every knowledgeable person would concur that the location of your investment is the single most crucial factor to consider. The perceived appeal of an area contributes to an increase in the property values there. Have you ever seen the expression, purchase the ugliest property in the most desirable neighborhood? This is accurate to a certain extent. It is a better investment to purchase a home that needs some work. Still, it is located in a desirable neighborhood than it is to invest in a good home but in an undesirable area. Consider investing in a region that is currently seeing rapid growth. Value appreciation is the only strategy that some real estate investors will employ. For instance, they may live there, or it's a vacation home that they bought with their money. However, most real estate investors want to increase their wealth by generating rental income. Not only does renting out the property you own to increase the value of that property over time, but it also results in a monthly income for you. It is up to you to decide the extent of your involvement. However, some landlords who use the services of a property manager can classify this income as passive. In a perfect world, your renters would cover the cost of your mortgage and give you a little extra cash each month. However, be sure to account for the cost of repairs and maintenance in your budget. Ways to get started with real estate investing. There are several different approaches to take when investing in real estate. Some are much more involved in the process than others, and a different amount of time and money will be required for each option. Real estate syndication. Real estate syndication is collaboration between multiple real estate investors with the primary objective of locating and purchasing investment properties. In most situations, the duties are distributed between a sponsor and many investors. Investors who participate in a syndication agreement are responsible for funding the purchase of the property and any additional costs that may be incurred to restore or repair it. Investors take on a more passive role and are compensated gradually, typically monthly or quarterly, through profits on their investments. After the exit plan's completion, the deal's syndication component is considered closed. For instance, once the property has been updated, remodeled, and sold. For their participation in the transaction, sponsors will each receive a predetermined sum of money as compensation. Buying a multifamily house. A person's purchase of a multifamily dwelling as their initial investment property is typical. When you buy a house with 2, 3, or 4 apartments, you receive the dual benefit of owning a home to live in and one or more investment units that may be rented out to pay for the mortgage on your primary residence. Even at the beginning of the process, you may discover that the rent you earn more or less covers your mortgage payment. And as time goes on and rents continue to go up, you might find that you have a worthwhile income. You can obtain financing for a multifamily property with up to 4 units using virtually any conventional mortgage product as long as you intend to occupy one of the units yourself. Bear in mind that this approach might present some difficulties at times. Finding and vetting potential tenants is one of the many responsibilities that come with being a landlord. Other responsibilities include performing necessary maintenance and repairs, collecting rent, pursuing delinquent tenants, and etc. And unless you have the financial means to pay someone else to do this stuff for you, it will all be on your shoulders to do it yourself. The average property manager will cost you approximately 10% of the rents you collect. Wholesaling. This one-of-a-kind technique is acquiring a piece of real estate for a price that is lower than the current market value and designating an end buyer to purchase the contract. Wholesalers never own the property, but they make money by tacking on additional fees to the end deal. Creating a solid buyers list is essential to the success of any wholesale business. In order to locate prospective customers, wholesalers frequently engage in lead generation campaigns. This requires marketing their firm, which may be done via emails, social media, or direct mail, and then establishing a list of potential investors who are interested in investing. To compile a buyer's list, you will want the investors' names, contact information, the type of finance they provide, and buying criteria. This will ensure that you are aware of the types of offers they seek and the best way to get in touch with them after you have located the ideal property. Because it does not involve a substantial initial investment, wholesaling is an excellent real estate investing strategy for novices because it can be started with very little money. Despite the fact that investors might require funding for effective marketing or payments of good faith, they won't be the ones actually buying properties. In addition, investors can construct a trustworthy network and develop a deep comprehension of the market in which they operate when they engage in wholesaling. Buying a vacation home. A second home can serve 2 purposes for its owners. First, it can provide somewhere to stay when the owner is away, and second, it can bring in rental money when the owner is not using the home. This rental revenue can help pay for the mortgage on your vacation home and cover other costs, such as property taxes and homeowner's insurance, as well as maintenance and repair costs. Another advantage of owning a vacation house is that it is typically more affordable to finance than a primary residence. The interest rates for second homes are just a hair higher than those for primary homes, and all you need to do to qualify for one is prove that you intend to live in the property for at least some portion of the year. Naturally, just like any other type of landlord, vacation homes have a mountain of fees related to the operation of their rental business. You'll have to pay someone else to handle everything if you cannot do it yourself. Things like cleaning, dealing with vacationers, resolving issues, collecting rent, and marketing. Real estate prehabbing. The method known as prehabbing is also an excellent choice for new investors in real estate. In contrast to complete prehabilitation, which necessitates the expenditure of considerable cash for significant modifications, a prehabilitation project necessitates only minor improvements. In most cases, investors will improve a property only marginally to attract other investors' attention visually. The term prehabbing refers to the process of making less drastic improvements to a property through the use of sweat equity. Investors who are considering this tactic should be aware that only some properties have the potential to be good candidates for prehab. Look for homes that still have structural integrity but need a simple cleaning. Stay away from houses that need expensive repairs immediately. When looking for prehab houses, location is another crucial consideration you should constantly keep in mind. Research the market and determine which communities are already established and rising. When learning to invest in real estate, it should be easy to see the appeal of prehabbing a property. Compared to other investment avenues, It not only has a low potential for loss and requires little effort on the investor's part, but it also has a high rate of return. Keep in mind that the goal of prehab is to learn how to sell the sizzle, not the steak. Online real estate platforms. Deals and projects that are in need of financing will be posted on the website by developers. Investors will then have the opportunity to provide that money, either in the form of a loan or equity. This results in a profitable arrangement for both parties. Investors can enjoy the advantages of investing in real estate without having to deal with the ownership or the labor involved. The developers can obtain the necessary financing for the projects. Always keep in mind that providing funding for real estate ventures can be just as hazardous and speculative as investing in real estate yourself directly. Always prepare thoroughly before entering into a transaction by doing your research. Investors can invest in a single project or a portfolio of projects, and they stand to gain from receiving distributions on a monthly or quarterly basis. In addition, it is a fantastic strategy to diversify the locations of your real estate investments. The funds that investors invest in may become illiquid during the lockup periods if they use a real estate platform, and the investors will be required to pay membership fees for the platform. Real estate investment trusts, REITs. One of the more conventional ways to invest is through real estate investment trusts. You invest in real estate value without purchasing, fixing, maintaining, or selling physical assets. Individuals can participate in large-scale income-generating real estate through real estate investment trusts, or REITs. Real Estate Investment Trust, REIT, is a firm that owns and often operates income-producing real estate or associated assets. A real estate investment trust, or REIT, is unlike other real estate corporations in that it does not construct real estate properties to resell them. On the other hand, a real estate investment trust is one that buys and develops properties largely with the intention of operating them as part of its own investment portfolio. Regarding making real estate investments, REITs could be the easiest method to go about it. There is no need to obtain mortgages, and no renters or repairs need to be made. You are in a position to kick back, relax, and watch the money come in. Like any other type of investment, the potential return on this one comes with a greater degree of danger. So make sure you do your homework and investigate each REIT thoroughly, just like any other investment with a good chance of succeeding financially. These types of REITs registered with the SEC and traded publicly on a stock exchange are most likely the most secure. Which kind of investing in real estate is best for you? Most individuals believe that purchasing their residence is an excellent strategy to get started investing in real estate, and other people find that having a renter or two in their home is a fun way to bring in some extra cash. This fundamental tactic requires some effort and entails expenses. However, those costs are already factored in for any homeowner. Unless you choose to invest in a REIT, all other types of real estate investing include increasing the responsibilities, dangers, and potential benefits of home ownership. When you take on more of the labor yourself, the higher your potential earnings will be. Being a landlord is more complex than it may seem, especially in the beginning stages of the business. Tenants are notorious for being tough to manage. To keep your vacancy rate as low as possible, you should hold on to the good ones for as long as possible. Even if you perform most of the effort needed to keep the units in good condition, it may still be relatively inexpensive, depending on the buildings you purchase. Renting out a vacation home might involve a significant amount of additional work. You need to acquire the property close to your primary residence to avoid having to hire help for a never-ending list of errands. That will obviously have a negative impact on your profits. Real estate investment trusts, REITs, could deliver satisfactory returns with relatively little work. Proceed with them if that is what you have in mind when you are thinking of investing in real estate. However, choose yours with great care and caution. Benefits of investing in real estate. When considering leverage, real estate investments are an excellent strategy to create equity in an investment. On average, the value of properties rises over time, which means that in addition to your monthly loan payments, your equity will grow on its own. When looking for fresh financing, you can leverage your existing equity, which can be of great assistance to you if you are in need of finances to buy a new house or some other kind of investment but cannot afford to do so on your own. Additionally, real estate investing offers a beautiful chance to diversify an existing investment portfolio. Real estate is an investment that tends to be more stable over time compared to other types of investments, such as stocks. Similarly, it does well in the face of market shocks. Investing in real estate can also provide investors with a hedge against inflation. This is because as the economy improves, there is typically an increase in the demand for real estate. As a result, property owners have the potential to benefit from higher valuation, greater demand for rental space, and more. When looking at the historical performance of real estate over a period of time, one of the additional benefits of real estate is the long-term stability it provides. In addition, this kind of asset can supply investors with a source of passive income, which is especially beneficial for owners of rental properties who collaborate with property managers. The risks included in investing in real estate. Leverage, or the practice of borrowing money to finance an acquisition or project, is responsible for producing a sizable portion of the returns earned by investments in real estate. When purchasing real estate, an initial deposit of equity is typically made, with the balance of the purchase price being funded through debt. If things do not go as organized, this leads to increased returns on equity for the investor. Nevertheless, if things do not go as planned, this might result in financial ruin much more swiftly than a portfolio of fully paid common stocks. The most conservative investors require a debt-to-equity ratio of no more than 50%, or, in more extreme circumstances, 100% equity capital structures. If careful consideration was put into choosing the assets, these could generate satisfactory returns. To properly understand and master real estate investing requires a significant amount of practice, experience, and exposure over many years. So that's all for today's video. If you like this video, click the like and the bell buttons. We'll have another video for you soon. Take care until then.